Hello and welcome to this Edison audio interview with James Smith, the manager of Premier Global Infrastructure Trust. It's Wednesday, the 17th of June, and we will be discussing James's strategy for the trust, both now and in the future. James, welcome.
Thank you. Good morning.
So, your exposure to renewable energy in the trust has doubled so far in 2020. From a little over 30% at the end of December 2019 to more than 60% currently. What's informed this decision?
Well, we've been looking very carefully at renewables for the past few years, and the weighting has been about 30% now for I think the past 2 or 3 years. And of course, with the market correction that we saw in February and then accelerating in March, that threw up a number of very exciting opportunities and mispriced investments. And we believed that the renewable energy sector was very oversold. From our knowledge of the sector, we didn't expect shares to move in the way they did. Renewables should be really, in theory, a very defensive revenue stream. And therefore, the opportunity to buy them at such attractive prices in March made good investment sense. So essentially, we took advantage of the market correction. Now, one important thing to understand about renewables is that in the face of a reduction in electricity demand, the system operator or national grid or whoever it is, wherever you are in the world, will tend to turn off thermal energy such as coal or gas first in preference to renewables. Because renewables don't have any marginal cost associated with generation, they tend to always be running. So they're quite good investments when you're faced with a reduction in demand of the sort that we've had over the past few months. And I think now the market has realised that. Those share prices have gone back up quite smartly, and the investments we made in March have turned out to be quite well timed.
Great, thank you. So Premier Global Infrastructure, or PGIS as I believe it's known, it's not just got ordinary shares, it also has some zero dividend preference shares which are maturing in November this year. What are the plans to either repay or refinance those zeros?
Yeah, good question. So in the AGM that we've just had in April, we extended the life of the trust for a further 5 years. So we have 5-year continuation votes. And the current issue of zero divs mature in November, as you said. So we now have visibility on the life of the fund until 2025. So all else equal, barring any major disasters in the market, for instance, or some other event that we can't foresee, we would at this stage intend to refinance all or most of the zero dividend prefs through till 2025. So we'll be spending a few months in the run up to that talking to our existing zero dividend preference shareholders, gauging demand and hopefully having a replacement issue.
Okay, and so those zeros presumably provide you with some gearing, and then you've also got now that visibility over the next 5 years. So looking ahead over that period, are you intending to increase your renewable energy exposure even further?
Well, of course, with the with the rollover of the zeros, hopefully later this year, it is a good time now to be thinking about the strategy that we would like for the next 5 years, and that's something that I've been talking to the directors about over the past few weeks. I mean, it seems to me that the renewable space is a very exciting space, and that's something that we've had a lot of success in recent years. I think it's probably been our most profitable investment area. So, that's certainly something I'd look to develop further from here, certainly. I think the sector is still very attractive and really is still in its infancy in comparison to where it could be in a few years' time. So I think certainly without having made any major decisions on the precise objectives and strategy, I think renewables is going to be increasingly important to us.
Okay. And I suppose we've seen that really, as you say, with the energy use in the UK over the last couple of months, that you know, we've not burned any coal for a couple of months now, I believe.
Yeah, that's true.
And so, I mean, obviously that's good from an environmental perspective, but also, as you say, its marginal cost is much lower. What is driving the development of the sector? Is it more the environmental side, or is it more the cost argument?
Well, if we'd been having this discussion a few years back, it would certainly have been the environment. But recently, you know, over the past 2 or 3 years, but certainly last year and this year, renewables have reached an inflection point whereby if you wanted to install new generation capacity, renewable energy is the cheapest way of doing it. And in particular, in places like the US and some parts of Latin America, that really is the case. They are the lowest cost form of energy generation. So in many ways, you know, you can now invest in the sector, A, on the grounds of the environment, or B, irrespective of the environment, simply on the grounds that they are the lowest cost of generation. Therefore, they are the area that will emerge as the long-term winner in the electricity sector. And you know, we expect the renewable costs will continue to fall. You know, wind turbines will get bigger. The cost of manufacturing solar modules is continuing to fall. And then, you know, alternative technologies such as gas, you know, if you wanted to build a new gas-fired power station, then, you know, it may make sense at the moment. But of course, in 3 or 4 years' time, gas prices could be higher than they are now. Carbon prices may have increased. In fact, there's only the UK and Europe actually that has, in reality, a carbon price. So by building thermal energy, you're taking on all these risks which are not really foreseeable just at the moment. So renewable energy, you know, you lock in your costs because most of the costs are capital costs. You can lock those in today. You can have a long-term contract with an off-taker, and you can secure your return at an early stage in the investment process, whereas thermal energy is not like that at all. So yeah, we think there's still plenty more room for growth.
And this is despite the removal of subsidies in most markets.
Well, when we talk about removal of subsidies, what we mean by that is removal of subsidies from new projects. So older projects which have been in the ground, you know, for 4 or 5 years, say, will have been built under a certain renewable incentive scheme or feed-in tariff. That would usually last for 15 or 20 years, depending on where you are. But yes, the fact is that new renewable energy in many places does not need any form of subsidy, particularly, say, in the US. Currently, they do have a tax credit, but that will probably come off. I think it's coming off next year. China talking about removing subsidies. And in some ways, you could read that rather negatively. But in fact, the reason they're doing it is because capital costs have fallen so much. You just don't need those subsidies anymore. So from a political risk perspective, the sector is becoming far less risky. I mean, if you can build new projects without any risk of subsidies changing or whatever, then surely that makes more sense if you can do that.
Okay. Now, just coming back to the trust, there's obviously there's a number of renewable energy funds out there. So much so that the Association of Investment Companies has actually made a whole new sector for them. How does PGIT's renewables exposure differ from the existing solar and wind power funds that are on the market in the UK?
Yeah, there are quite a number of major differences. I mean, of course, the most obvious difference is we are investing in listed companies. To my knowledge, I don't know if there's any investment trusts which are, you know, have a higher degree of renewable energy specialism as we do, investing in listed companies. I think they all invest in direct projects akin to private equity. So they will own a direct solar farm or a wind farm or whatever it happens to be. So that's the main thing. I mean, secondly, we are global, whereas the others tend to have a particular specialism, usually into the UK itself. And I think, that's also attractive because, for instance, if you're investing in renewable projects only in the UK, if for whatever reason in a few years' time the UK is no longer attractive as a renewable energy market, you're kind of stuck. Whereas we don't need to be in any one particular jurisdiction. We can go wherever the returns look most attractive. And I think really the third key point of differentiation would be that we have a whole myriad of different technologies. So most of the funds out there would tend to specialize in either wind or solar or whatever it is, whereas we include wind, solar, hydro, biomass, and then other areas such as energy storage, companies doing energy efficiency projects, or companies providing specialist finance for renewable energy. So we have a much broader spread of exposures to the sector.
Okay, now you mentioned energy storage there. How important is the development of energy storage in bridging the gaps between renewable energy supply, which, as you mentioned, is always on, regardless of whether it's needed, and demand? And will this be another increased area of focus for you, do you think?
Yeah, I mean, the two have to go together because, the thing about electricity is that it's very difficult to store electricity. You can store it in a battery or other forms, but, traditionally you've used electricity as it's being produced. Now, you can't turn renewable energy off and on. It depends when the sun's shining or when the wind's blowing. I mean, large-scale hydro with a hydro dam is slightly different. Of course, you can call on that to run or to close. So increased storage capacity goes hand in hand with increased wind and solar development. Now, there's a number of different ways that you can store electricity. The most obvious one that seems to be getting most of the headlines is batteries. And there are a number of companies, funds rather, that are investing in that, and we own one of them. But also a number of companies have large-scale pump storage hydro dams. So, for instance, SSE or Drax Power. And if you haven't come across that, essentially what it is, it's a dam, a hydro, and when electricity is very cheap or the electricity price is negative, if the grid wants to shed power from the system, you use that to pump the water into the dam, and then when the price is high, you let it flow through the turbines and generate electricity with it. So that's quite an old technology that's been around for a while, but looks like it's increasing in value. So yeah, there are a number of ways, and also that then brings us on to things like hydrogen, which is probably slightly further into the future. But yeah, it's an area that we're certainly looking at and expanding in.
Great. Has your utilities and infrastructure and things like that, they're seen as a fairly reliable income generator, I guess. Has the increased renewables exposure led to any change in PGIT's income profile?
We, of course, monitor our income very carefully, and we've had a number of investors ask us about dividends and the income forecast for the trust, because, of course, income has been quite a big topic over the past few months. And you're right, utilities tend to be fairly reliable dividend players. Now, for renewables as a sector, there's a whole range of different companies. So some companies like the UK renewable companies, which have a portfolio of renewable projects, they tend to be quite high and reliable dividend payers. Whereas other companies that are perhaps, say, developing new projects and a slightly higher growth and need to retain more of their cash flow, they would have a lower dividend. So really, with a renewable energy portfolio, you can make the dividend as high or as low as you want, depending on what kind of companies you choose to invest in. All I would say is for us, there's been no particular impact on our income level from having gone from 30% to over 60% renewables. It doesn't look to have changed that much. So I'm not proposing to change our own dividend policy, particularly as a result of this change.
Okay, and what's the yield on the trust at the moment?
Well, the dividend last year was 10.2 pence. The shares are currently, there's a wide spread on all, particularly smaller investment trusts at the moment. So the shares are quoted at roughly £1 to £1.20, with the NAV closer to 1.30. So at a mid price of about £1.10, say, the yield is about 9%.
Okay, that sounds very attractive.
Of course, partly that's a reflection of the capital structure and the zero dividend preference shares. Just to give you an idea, the underlying yield on the portfolio is about 5%.
Okay. So finally then, James, how has the COVID-19 pandemic and the lockdown affected both your life as a fund manager and how has it affected the renewable energy sector?
Okay. Well, the first one's quite an easy one to answer, and I guess is the same as most other investment managers that you've been talking to. It hasn't affected me particularly on a personal level that much. You know, the technology exists that we can do our jobs from home these days. Of course, I miss going into the office, and I miss having face-to-face contact with clients and with companies, and that's been replaced with Zoom calls such as this. So, you know, I would like everything to go back to normal, but we can function almost normally working from home, so that's okay. With regard to the second part of the question, the sector seems to be carrying on pretty much as normal. And in fact, the International Energy Agency produced some forecasts the other day showing that they expect renewable energy generation in 2020 to actually increase over 2019, whereas most other forms of generation will be down by 7 or 8% or so, with the overall global electricity demand being down about 6 or 7%. So because of this, this issue of the merit order, which we discussed earlier, where renewables, if the wind's blowing, you're selling your power, they're not too affected by demand. So it's probably the best area of electricity generation to be in during the current, difficult times. You know, I think for some new projects, maybe that there's been slight delays on the construction. But you know, if you're building a wind farm or a solar farm that's going to last 30 years, then you know, if it happens to come into service a couple of months late, it's not necessarily the end of the world. So I think any problems we've seen are perfectly manageable, and I wouldn't want to overemphasize them. All
right. Well, James Smith, thank you very much. I've been Sarah Godfrey of the investment companies team at Edison, and this has been our Edison audio with the Premier Global Infrastructure Trust. Thanks very much, James.
Thanks, Sarah.